evening, ladies and gentlemen. Welcome to yet another virtual investor briefing. I'm your host, Dan Theok, Senior Vice President of Investment Banking, and today we'll be talking about DOLLA Financial Services Limited and looking at their Q3 financial results. Joining us today is none other than the beautiful Group Chief Financial Officer, Trevine McKenzie. Hey, Trevine, how are you doing?
Good, Dan. Thanks.
And the not so beautiful Ken Roy. Ken Roy, what's happening? Also, I'm joined by Patrick Battier, our CEO of Mayberry Investments. Hey, Patrick.
Hey, everyone.
No adjectives required. He's a great guy. And me, myself, and I. Apologies for the absence of our Chairman Barry and Group Chairman for Mayberry Investment Limited, Gary Parrott. Okay, well, guys, if you're a fan of the content, subscribe to stay up to date with our uploads. Be sure to hit the like bell to receive all future notifications because we publish videos like this just about every single week. If you're looking to embark on your very first investment journey, take that first step with Mayberry Investments, of course, and follow us on social media today to get started. Don't forget that we'll have a Q&A segment at the end of the program, so make sure you submit your questions so we can address them at the end, and I can see some coming in already. Okay, with that, I would like to jump straight into our review of the results for the Q3 for the 9-month period to September 2024. And they continue to be impressive. Again, just reminding you guys, this is a junior market company that came to the market about 2 years ago with profits under $100 million, and here we are now seeing 9-month year-to-date profit of $339 million. But into the details, we can see that they've grown their interest income by 23%, up to $1.1 billion. And similarly, the net interest income has grown by circa 22%, up to $903.5 million. That's obviously aided by the growth in their loan book, and we can see total assets are up by 21%, and their loan book specifically is up to $3.1 billion, I think it is, Kenroy. Your loan book's up by 19%. to $3.1 billion. So good job there. And we'll talk a lot about that and the future growth and potential for growth and further growth in that loan book and thus the profitability of the business. Operating expenses up by 19% to $499.5 million. And that results in a PBT of $369 million, which is 10% higher than the prior year. Seeing a little bit of growth in income taxes, presumably related to the Ultra Finance business, the subsidiary that is not listed and therefore has to pay taxes, but we'll get that confirmation later. And the net result is profit for the 9-month period of $339.6 million, which is up by 4% compared to same period last year. Total assets, as I mentioned before, up by 21%. That's growing their loan book primarily, which includes loan book growth of 19% to $3.1 billion, as we said before, and they're sitting down on about $202 million cash at the end of the period, which is going to be unlent in short order, I'm sure. And they're funding that through growing their loan liabilities, and so we see total liabilities up by $500 million to $2.5 billion, or up by 25%. What I like about the business is they're growing their loan book and maintaining very healthy financial covenants. So ECLs only 3.9%, which is actually an improvement over the prior year, where it was at 5%. The NPLs, or non-performing loans, I should stop using so many acronyms, are very healthy at 9.7%, maybe 70 basis points increase over the prior year, but well below industry norms for this type of microfinance business, where we're used to seeing NPLs closer to 15%. And despite that increase that we saw in operating expenses by 19%, we can see that the efficiency ratio has actually improved from 49% last year to 48%. Any lies told so far, Trevine? Am I fairly accurate here? You good with the numbers?
Fairly accurate, Dan.
Good deal. Moving on to the key statistics. This is where I go a little bit crazy because, we're stock guys and it's not their job to watch the stock price. It's my job to watch the stock price and look at shareholder value. We see the stock price up to $3.32, so good growth in the stock value. That's a PE of 19 times in a junior market where the Harmeen average is about 18 times. So it's trading at a small premium, but I'll explain to you why it is relative to the market. I think it's because of the potential for growth and profitability coming forward, which the market recognizes. trailing earnings per share at 17 cents, trailing earnings at $430.6 million. So again, in the year before you IPO, just 2 years ago, Trevine, your profit was like $100 million thereabouts. I mean, this is substantial growth. Here you are 2 years later, and your trailing profit for a 12-month period is $430.6 million. And I believe next year we're going to see that grow to be on $500 million. Now, time for me to declare my conflicts or the Mayberry conflicts. So we are obviously top 5 shareholder, as in between the Mayberry group. So we do have some, it's an associate company, just to make that clear, but my analysis has nothing to do with that, but I do like to declare the conflicts. So when I'm promoting these things, people can appreciate the position of our group. It's definitely a stock we like. We like it so much that Chairman last year, Patrick, spent over $1 billion across the group to hold a position in DOLLA Financial Services, and it's something that we have no regrets about. We took a further position earlier in the year, around about July, I want to say, at Trevine, and this is happening above your head, but I'm sure you're looking at your shareholder register and figuring it out. I think we took an additional 4%, maybe at $2.40 in July, thereabouts this year, and here we are, not even 4 months later, and the stock's up to $3.30. I think I'm going to set you guys a target of growing profitability by at least 30% and watching the stock price grow by at least 30% over the next 12 months. As a financial analyst, that's what I expect. More conflicts. So we're also financial partners, and it's my job to help you guys raise funding, and we'll talk a little bit about that. So I do have some insights as to why I think these guys are going to easily be able to grow their profitability by $150 million over the next 12 months. We'll get to that in a second. Next slide shows profitability by a quarter. And we can see that in the third quarter, there's actually a little bit of a drop off in the profitability for that quarter specifically. And we'll talk a little bit about that, Trevine, so we can have an appreciation as to why you have broken a nice 7-month run rate of doing over $100 million per quarter. This is the first time in 7-8 months that's happened. I'm sure there's a logical explanation for that, and I'd like to appreciate how you're going to get back up to 100 million and actually to 120 million, because I'm 125 million. I'm really looking for sort of a minimum profit of $600 million next year. As an analyst, that's I think that's very doable. We can talk a little bit about that. Next slide shows the movement in the stock price, folks. And again, we've seen some good movement in the last 12 months. Again, guys, this stock IPO'd at $1. So if you were like me and bought it at $1, only got 1/10 of what you wanted, because it was one of the most oversubscribed IPOs that I can recall in the last decade, with them trying to raise roughly $500 million between company and selling shareholder, and being oversubscribed like tenfold, bringing in $4 or $5 billion. So you really only got 10 cents on the dollar of what you subscribed for, but I ran and bought back on the open market for like $1.50. And I'm very, very happy. And I continue to hold my little much, and look forward to seeing the stock price getting up by 30-40% in the next 12 months. So my quick analysis of the numbers as your friendly neighborhood financial analyst. I do want to talk about some of the financial covenants, Trevine. So first question I'm going to sort of kick off to you is, we know, or I know, that we, on-lent you guys $400 million probably in late September, on-lent you another $400 million in sort of mid-October. We're in the middle of a raise for you to raise a minimum of $1.5 billion. I'm happy to report we'll close that raise in the next 5 days. So we will have raised $1.5 billion for you guys to on-lend and do what you do best. And what I like about the business is, despite your growth, 20% growth in the debt book in the last year, 150% growth in the last 2 years, you're still maintaining really healthy financial covenants. And by that I mean, like, interest covers 3 times, which is really healthy. Debt to equity only 2.3 times, and your debt to EBITDA only 2.8 times. So really healthy level of leverage. And so what I'm curious to know is, if we have a target of growing this loan book by $2 billion over the next year, is this something that you can achieve? And how do you guys, between yourself and Crenroy, feel like you're going to be able to go about and do that?
Well, Dan, definitely that is something that we think we can achieve. Well, first of all, that once we take on debt, or before we even take on debt, we conduct a comprehensive interview as to how it will impact our key ratios. So that's the first step. So we look at our debt covenants, such as our interest coverage or debt to EBITDA and or debt to equity, just to see how those pan out based on what the board has set for us, what we have set for ourselves, and also what our other debt covenants look like. So having done this review, we are confident that the funds we have raised will continue to positively impact our financial health. And this holds true for all future raises. Now, once we get these funds, Kenroy's team will definitely be on lending those as prudently as they are used to. And maybe he can talk a little bit more about that, the plans, the strategy as to how we will on lend those funds once we get them.
Please do. And Kenroy, give me a little color. So you've grown this loan book, substantially to over $3 billion, got another $1 billion of growth going in the pipeline. Give me a feel for the color of your loan book today and how you see that progressing in terms of secured, unsecured, commercial versus personal, those types of colors so we can appreciate, is this $3 billion of ticky, what's the average loan size, average duration, that type of thing. Because you're microfinance, but you also have a subsidy in there that does high net worth lending. So just give us a little color about this $3 billion loan book, soon to become $4 billion.
Right. So we're inching very close to that $4 billion mark, Dan. And as Traveen said, the most important thing is actually getting lending the funds, but the most important thing is actually ensuring that we're doing it prudently. We have our own internal metrics that we use, such as the secured loan ratio. That is probably something that, as a microlending institution, we're probably the only person who track that ratio and report that on a quarterly basis. So we have set ourselves a standard that 80% of the loan that we disburse will be secured. And I mean, that would have been driving some of the lower than market non-performing loan and ECL expectation that we're seeing. So we will continue to maintain those strategies. The portfolio by large is comprised of about 85% business loans, while we lend maybe about 15% to personal or consumer loans. So you tend to find that the loans that we lend to business are on the larger size, averaging about $10-15 million per customer. And we will just continue to maintain those strategies. I mean, while we focus on building these businesses, you find that the referrals are really coming in. And as such, we can maintain a healthy pipeline to effectively and prudently disburse that additional $1 billion.
Great. Dan, if you don't mind, I have a question.
Please.
I know you brought up the NPL staying steady at 9.7. Just curious, what strategies do you guys have in place to maintain that or improve that, especially as your portfolio is growing?
Right. So the NPL at 9%, as Dan would have alluded earlier, is below our internal target. It's below the industry target. At the same time, we do believe that there are things that we can do to improve this. One of the main reasons why we have a sub 10 NPL ratio is because of the secured loan strategy that we have employed. Because you do know when customers borrow and they have something to lose, they will ensure that they continue to pay. So you find that we will have a little fluctuation here and there. For example, in the last quarter, I do know that we had maybe about 1 or 2 loans that were that ended up in the NPL bucket or the non-secured loan bucket. However, sometimes we find that we see these fluctuations, but it cures itself in the following quarter because we're able to either liquidate asset or we can negotiate with the customer to get the accounts back in line or back into a performing state. So once we continue to maintain focus on that sub 10% NPL, and we continue to maintain the secured loan strategy along with just prudently assessing the applications to ensure that these are customers who can in fact prove their ability to repay, then we believe that we will be able to maintain and even improve from the 9.7% that we're at currently.
Great. And Traveen, we see, thanks, good question, by the way, Patrick. We see the ECLs, also very impressive. So let's, talk a little bit about that. I mean, you guys really go through a rigorous process of evaluating those ECLs, and it's just not at the year-end audit, right? This is something you do every quarter, or you just kind of like dreaming up the numbers during the quarter, and then doing the real test at year-end. How does that process really work?
No, I wish we were dreaming up those numbers every quarter. It would be even better. But we have a strategy whereby we contract out the job to have the ECL calculated, and this is done on a quarterly basis just to ensure that throughout the year we are reporting as accurate as can be that expected credit loss, which is a very important metric for us and really impacts our profits and our expenses. So we take pride in having that done externally. It is independent and it is as accurate as can be, because at the end of the year also, once we get audited, or investors or stakeholders will also notice that there is no change, or if there is very little change to that number because it is being done on a constant basis.
Good deal. So no chances of us getting any surprises in relation to your ECLs in the last quarter of the year. Speaking quarter and profitability, there was a dip in the profitability, Trevine, in Q3, and as I teased you, it's the first quarter and maybe 7 quarters you dip below the sort of $100 million mark. Do you want to just explain to us a couple of things which contributed to that dip in Q3, and why we can expect you guys to get back to a good run rate going forward?
So the simple explanation for that dip is the lack of funding throughout the second and third quarters of the year. We would have done a significant enough fundraise last year, Q4, which would have been the DBJ facility, upwards of $500 million. And we would have unlent that in the Q4 of 2023 and Q1 2024 period. So that would have boosted our income for those 2 periods and would have taken us into Q2 somewhat. But we did have a dry spell in terms of funding between Q2 and Q3, which would have led to a small fall off in the amount of loans we could have done throughout that period. But Dan, you did mention at the start of the program that we are in the final phases of that fundraise that we are doing with Mayberry, and that should take us back into the growth phase that we are working on. So we should see income increasing for Q4 and Q1 going into next year, which would really be returning us back to the growth, the kind of growth that we're used to.
Good deal. And I don't want to give away your secret sauce, but just like at 20,000 feet, if we could just economics of on lending. So you've got the machinery in place and the operating team to on lend. So in theory, this $1 billion, if your average lend out rate is 30% and your average cost of borrowing is 12%, is it sort of fair to say that we should see you making like a 18% spread on $1 billion and that sort of flowing through to the bottom line? Is that kind of, at 20,000 feet, the sort of financial impact of you growing your loan book by $1 billion?
Maybe a 40,000 feet, but yes, somewhat.
Good deal. All right. So from my analytics, I'm expecting to see, $180 million improvement from that $1 billion that you lend out. That's not, unreasonable, right? At 20,000 feet, look at it.
Well, from 20,000 feet, no, but we can anticipate some economic fluctuations that may impact that.
Yeah.
But from a straight line basis, you are in the ballpark.
Back of the envelope. Okay, good deal. We
Yes.
look forward to it. Patrick, any more questions from you?
Sure, Dan. One of my favorite ones, which operating expenses. Since we're talking about profitability, notice that operating expenses have increased significantly. Can you please provide some details on the components of those expenses and any plans to manage or reduce them? Excuse me.
Sure, thanks. And that's a very good question, actually. So we at DOLLA, we have always been very efficient in how we operate the business, and we are really in a market to raise funds and grow, which is what we are doing. But in order to prudently disperse the funds that we have and to collect, we need competent staff. And our staff are really our backbone. They are those perfect resources that are not sitting on the assets, and we try to ensure that we compensate them as such. So we conducted a benchmarking exercise last year, which saw a 15% overall increase in base salaries for all staff, as well as adjustments to our benefits to ensure that we are very competitive in the market. So that's the very first line item that you may see that led to the increase in operating expenses or staff costs. And we're really seeing the returns on that as well, since our revenue per staff or revenue per employee has increased just about 20% year over year. In addition to staff costs, we're seeing increases in audit fees, which is something we are seeing across the industry, and just general increases due to inflation, the growing portfolio, and just the general cost of doing business. But our expectation is that income will begin to increase, as I mentioned, in the coming quarters, and that will absorb the expenses and the increases that we're seeing as we prepare for growth.
Okay. And then just a follow-on question. So the report mentions a dividends payment. Can you elaborate on the company's dividend policy and any plans for future dividends?
Yes, so we view dividends at DOLLA as a tangible way to share a portion of the company's earnings with our shareholders, and as a reward for their investments and their continued support. So we have a very robust but very streamlined dividend policy. It speaks to a 50% payout ratio based on a variety of metrics, including, our earnings, free cash flow, and or cash flow coverage ratio. So as to not restrict our growth and to prevent us from falling behind on our obligations. So that's the analysis that we do before we even consider paying dividends. We actually declared a dividend payment of 5.9 cents per share in July, and the market would have also seen an additional dividend declaration of 0.8 cents per share, I believe, last week, just to catch us up with our year-to-date earnings and our 50% payout.
Thank you.
Good deal. Thanks for that. All right. I got a question about the regulatory environment. I'm curious to know, given the regulatory changes and the license to operate at the micro institution, how has that affected your operations and compliance costs? And then how do you think that may impact the market overall?
If I can take this one, Dan. So
Please.
we received our microcredit license about 2 years, almost 2 years now. I think we're in the second year of renewal. So we received in 2022, we renewed in 2023, and that process has really been smooth in terms of the renewal process. Operationally, we're seeing where we have been required to do a little more to comply with certain BOJ requirements, such as doing AML audit, which we weren't really doing prior, and the associated training and the system development that we need to do as a precursor to carrying out these tasks. So we do find that we have to make adjustments to our system so that this can meet the BOJ requirements, and we have to get training done for our staff. And these actually came at some additional cost. Nevertheless, we do not find these to be very material or growth impacting for the business. Generally speaking, I believe that a number of microcredit institutions have now, a number of institutions that operate in our space have now received their licenses. I think up to the last time we're at about 65 companies. And I do know that there are still quite a few operating in the industry. But so far we are pretty satisfied with how the system has been working, and just not a lot has changed, because prior to us receiving our license, we were in fact operating as though we were a licensed microfinance institution. So there hasn't been a lot of changes, just that we have had to add additional staff, we've had to make adjustments to the system, and we've had to do complete additional work surrounding audit to ensure that we are in compliance with those requirements from the BOJ.
Good deal. Thanks for that. And in relation to Ultra, how is that business doing? And, what's the size of it? You give us a feel for what's the size of that business now, one, to the overall profitability of the business, value of loans underwritten, and then tell us a little bit about how Ultra is different in terms of the types of loans you're doing there, maybe size-wise, give us a feel for, largest loans, smallest loans, average durations, just trying to get a sense as to how is Ultra a little bit different from the regular microfinance business that you're doing. And I will confess that I'm now stealing questions from folks online. So again, folks, please feel free to send in your questions, and that part of that question is mushed with the questions we got in from Jerome.
Okay, so Ultra, in terms of a loan portfolio size, we're looking at about 42% of the overall portfolio as at September. So if the portfolio was at 3.1 billion, I believe Ultra would have been about 1.3 billion dollars in terms of loan portfolio size. And in terms of profitability, we're looking at about 50% of the profit that would have been reported for the 9 months ended. Of course, Ultra is a much smaller team, so some of the resources are shared between Ultra and DOLLA. There's a key difference in terms of the operation though and the focus of Ultra. So DOLLA is really in microcredit, while Ultra focuses on private secured lending to high net worth individuals. So you find that the business that Ultra does in relative to DOLLA is at a much larger scale in terms of the sizing of the loan, and in terms of the overall quality of the loans that are disbursed. The first requirement is that pretty much 100% of the loans that we disburse at Ultra are actually secured. So we have to have tangible asset, which for the most part we're talking about real estate or motor vehicle or reliable shares such as dollar stocks. So if you have some dollar stocks, you can always just get some advice from Ultra, and we can always design loan products that are that you can use those stocks to secure. But overall, the business has been growing tremendously over the last 2 years, and we do anticipate that a lot of the funding that we get now, typically Ultra represents about 50% of our disbursement. So we do anticipate that the growth will continue from the $1 billion funding that we would have been getting over the next several months.
Good deal. And what's the typical ticket size? So, what's too small and what's not too big? So, speaking to folks out there.
Ultra, I believe we are averaging about $25 million per loan at Ultra currently.
Okay, very good. And duration, what's typical duration?
And that would be about 12 months.
Good deal.
In terms of duration.
If I wanted to borrow $2 million, could I come to you guys at Ultra? Is that too small?
Well, $2 million would not be too small, because there are actually persons who are high net worth, which wouldn't fall under microcredit.
Right.
And if that person needs a $2 million loan, then of course we will facilitate it, or they will facilitate it at Ultra.
Right.
For sure.
Gotcha. And can we do any creative forms of security? Can I use my dad's Rolex watch or my art collection? Do you guys do anything in terms of alternate security?
And that's the beauty of Ultra. There's really great flexibility when it comes to just designing that tailored solution for each customer. So of course we will assess the asset that you have. Originally Ultra would have been we would have done some lending with luxury item, which Dan, you can use your Rolex watch.
My dad's Rolex watch.
Right now we are focusing a lot on private credit. We haven't seen a lot of luxury items, but we do have systems in place to value and assess these items and do put some amount of analysis in that, and whether you can in fact use it to get a loan.
All right, good deal. So a lot of questions coming in from social media. Patrick, do you see any that you want to throw at the team?
I think we touched on it, but one from Philip, which is, does Ultra have plans to expand into private credit for businesses?
Could you repeat that, Patrick?
Sure. Does Ultra have plans to expand into private credit for businesses?
Well, Ultra just did it's like a launch with a focus on private credit, and this is tailored for both individual loans and business loans. At this point in time, Ultra does a lot of loans for business customers, and as such, I anticipate that we will continue to focus a lot on business and really be focusing and doing a lot of work in the private credit space.
Okay.
Good deal. Any more, Patrick, that you see there that you find interesting?
No, I'll turn it back over to you, Dan.
Sure, good deal. So another question that's been bouncing around for a little bit, Trevine, and I'm going to put it out there. Not that you put it out there, but there's this perception that, hey, are you guys likely to do a spin-off with Ultra? And the thought process, I believe, is, Ultra is growing and it's paying taxes, and maybe, spinning it off would allow it to benefit from some tax shield. And then it wouldn't hurt that, if the dollar itself got in some more equity into the business, which might improve its ability to keep growing its debt book. So, any comments that you're willing to make about a possible spin-off of Ultra, either Trevine or Kenroy?
Well, I mean, as you know, Dan, before we can get into anything like that, we have to do our analysis to ensure that it's what's best for the business. I can say definitely that spinning off Ultra does have its benefits, as you mentioned, the tax shield, the additional equity for or ratios, and allowing us to, raise more debt, etc., which is great. But we still have to ensure that it's what's best for the business now. It's not off the table. It is, in consideration. And as soon as we can announce something like that, we sure will.
Great, great. I appreciate that. And that question, I believe, came in from Limitless Podcast. And Limitless Podcast, I know, some people are thinking, this is a no-brainer, you should do it. But then I think you also have to say to yourself, in order to list Ultra, we would have to give up a minimum of 20% ownership in that business. And then we'd have to go and calculate what the fully dilated earnings per share will be after we've given up that 20%. And if it's the aspect of the business that's growing the most, you might say to yourself, do I, actually want to do that? So we do have to do some analysis. And while it's good to get some equity, another option that the business has is just to, maybe not pay dividends for a year or reduce the rate at which it's paying dividends, reinvest the profits that it makes. It's going to make $600 million profit next year. And that $600 million of profit that it's likely to make next year, if it reduced its dividends to only $100 million, you would naturally reinvest like $400 million into the business. So it's something they have to look at. And I think as soon as the management feels comfortable and they take that to the board, I guess they could make a decision on that. Okay, let's look at some more questions coming in. One from Fitzroy Adams. Update on the plans to raise $2 billion by the end of the year. Any announcements soon? So maybe Fitzroy, maybe you mentioned it, or maybe we said it in a not so clear way. They have or will have, I want to say by the end of this month, successfully raised $2.5 billion in the last 12 months. So that's how they're funding the growth in their debt book. So congratulations to the team and for being able to build up the pipeline and to keep on lending that money. So what we have just witnessed, folks, effectively in the last year, and it'll be clear when you look at, I think, the next quarter's financial results, is the idea that DOLLA would have increased their loan book by over $2 billion in the last 5 quarters. And that'll be really evident when you guys look at the next financials that came out. As we said before, they got $400 million in sort of late September, another $400 million in October, and we expect to disperse the balance of a $1.5 billion raise in November to the DOLLA team. So I think they'll be fine. I see where Ultra is in the market for a CFO. Can you shed some light as to why this is the case? This is coming from Troyan Browning. Trevine, I'm going to direct that one to you. Is that accurate?
Yes, Ultra is actually in the market for a financial controller. As much as we would love to do the accounting and manage the finances of Ultra here at DOLLA, it is a growing company and it does need to stand on its own. So the intention is to build out the team, the back-end team as well, to ensure that they have the focus that they need to grow the way they need to.
Good deal. I agree with that wholeheartedly. So that business is growing and it's a separate legal entity. Yes, it's a subsidiary. And you're growing as well too. And we want to make sure that you have the right people in the right place, focusing on the right things. Troyan Browning says, Simone Johnson says, and it's Simon, Simon. Simon says, on a serious note, does Ultra really take DOLLA stock as security? Is this introducing risk the wrong way? And I'm gonna tackle him on this one if you don't mind, guys. So again, I think they're saying any listed company, especially if it's a publicly traded stock, they'll feel comfortable in providing loans against that. And I guess it doesn't matter whether it's a cousin or a parent or a person that they don't know. But I think they should be most confident in their parent company, actually. So the idea that they should feel uncomfortable about lending against a stock of their parent company would be of a concern to me. What they can't do is lend against their own stock, but there's no problem, Simon, with them lending against the stock of their parent company. And likewise, their parent company can't borrow against its own stock. So I think it's quite fine. We gave the update on the bond raise. Simon also asked about that and the deployment of the funds raised. So the bond is sort of finished, Simon, and the team has sort of said that they have a good pipeline of business working on, and they won't have a problem dispersing this $1 billion, $1.5 billion. So let's look forward to seeing the results, Simon, in the next quarter, where I think that'll be evident. So again, the bond that Mayberry, the private, and it's a private raise, so maybe that's why you guys aren't seeing it. So this isn't something that we have advertised or gone about. It's a private raise to accredited investors that was done as an exempt distribution under the FSC rules. Mayberry was the broker that led that raise. It was done privately, and so it wasn't something that was sort of in the public space in a big way. We've raised $1.5 billion from them, maybe 100 note holders, so very privately done. What I can say, and you guys can say you heard it here first, is we are considering a public raise, just discussing it, considering for the future. So I won't be surprised, because the objective will be to try to raise at least another $1.5 billion for the business next year. And so I think Trevine will go through the appropriate analysis and reviews, recommendation from board, approval by board. And I think the next time we're having this conversation and we're reviewing the December results, it could well be, if the sun, the moon, and the stars align, that you guys can experience and invest in a public raise done by DOLLA, which I personally, guys, think would be very successful. And I do think, as a business, we should give the public an opportunity to invest in the business, not just in the ordinary shares only, but also in the bond fixed income side of the business. So look out for that. You heard it here first. This is not a public announcement. This is me speculating, giving advice, and saying I think this thing is going to happen, lest I get myself in trouble. So, good questions, Simon and Troyan. Appreciate those questions. Philip Burgess asks, and I'm not making this up, have the newly announced board members completed their approval? So were there newly announced board members, and have their approvals been completed, Trevine?
Yes, in order to appoint them as directors, actually, they would have needed to complete their fit and proper assessments and all those fancy things that are in place to ensure that they are fit to be directors of a publicly listed and a regulated entity. So the answer is yes, Philip.
Good. And remind us, this was Walter Scott and Hesses Johnston. Is that it? Was there any others?
That's
That's
correct.
Okay, not so bad after all. I am getting old, but the brain works. And Philip says, great idea about the public raise. That'll be one of the people's favorites. So again, Philip, I'm just speculating. It's a thing, we're just discussing. I'm excited about it, but my wife says I get easily excited. So, wah, wah, wah. All right. I'm sorry, guys. This is a PG-13 program, so I think I'm okay with that. So so the results, net. I think the results year to date at $369 million PBT, 10% growth over same period last year are great. I will say I am a little disappointed about the, falling below 100 million for the quarter, but I have every confidence that you're going to make that up in the next quarter. So the next time we come back, folks, you all can be my witness. We'll be looking at the Q4 results, and somebody's getting a beating if they don't get to above $100 million again. And Kenrol, I'll let you choose whether I get to spank you or Trevine if y'all don't make $100 million. Somebody's getting a spanking. So, and Kenrol gets to decide who. Hopefully, it won't even be relevant because you guys are gonna break that $100 million mark, and we'll get another 8 quarters on the trot of you doing minimum $100 million per quarter. And Troyan is telling me I've missed some earlier questions. And you're right, because the screen was scrolled down. So let me look back at some of the earlier questions. Giovanni Hamilton asks, what caused OPEX to be so high? And so we kind of spoke to that, Giovanni, and I hope you appreciated the responses. And what I would say is, let's pay attention to the operational efficiency ratio, which improved from 49% to 48%. So while costs went up by 19%, income went up by 23%. So the operational efficiency actually got better. O'Neill Johnson says, will the spin-off of Ultra be soon? No response to that, Mr. Johnson, because we're just discussing, looking at the possibilities, etc. Jerome asked about the sharp increase in admin costs. Why did DOLLA choose to pay such a small dividend compared to your usual dividend? So this might be the catch-up question. Again, I think, Trevine, you kind of answered it. They've got a dividend policy that they try to be guided by, but of course, they're very focused on cash flows, etc. Maybe this is just me, Dan Theok, saying the funding for the business came in a little bit late. They're more focused on increasing the profitability of the business. They've got a lot more funding in place. So let's watch out and see what happens. But she did tell us what the dividend policy was, right? Up to 50% of the profits to be paid as dividends. And then I kind of countered that by saying, we also need to think about retaining profits to allow us to grow the business. And if they've got the objective of growing the business by $1 billion over the next quarter, and then $1.5 billion over the next year, that's something that we're going to just have to balance. But guys, from a financial analyst perspective, I'll tell you, I don't buy stocks mainly for the dividend, especially not in Jamaica. Average dividend yield is probably 3-4%. Best in class stocks pay 6-7%. I'm buying the dividend because I want 20% capital appreciation per year. I'm not getting 20% capital appreciation a year. I'm not a happy camper, guys. So what has DOLLA done over the last 2 years? Stock price has gone from $1 if you got it at IPO, or $1.50 if you couldn't get it at IPO because it was oversubscribed, to $3.30. So even if you came in at $1.50 and after 18 months, 2 years, it's at $3.30, you're definitely doing much better on capital appreciation. So I think, humbly, Limitless Podcast, that we should be more focused on watching the profitability of the business grow, which they've done, gone from $100 million a year to a run rate of $430 million a year. 4x improvement in profitability must ultimately result in 4 times improvement in the share price. So think about the dividends. It's a good thing to do, but I think it's more importantly to be focused on driving the profitability of the business. Just my thoughts there. Patrick, I don't know, do you have any thoughts about how you feel about dividends and capital appreciation? And
Totally agree with your views, Dan.
thanks, man. Appreciate that. All right, so guys, I think this has been a great program. I think hopefully we've allayed the concerns of folks about what's going on with the business. Hopefully, guys, we've given you good color as to what's to come. We appreciate that we had a little blip in the quarter, but on a year-to-date basis, we still saw 10% growth in the PBT. This business is a business that is run on spread, and if they can keep growing their loan book and maintaining their spread, and we can see from all intents and purposes that they are capable of doing that. They've grown the loan book by 19% and continue to maintain the level of net interest income spread and gross profit spread and operational efficiency. So all I care about is that you guys have a pipeline to keep on lending, that you can on lend this $1 billion over the next 60 days, 90 days, because that's naturally, as Trevine alluded to, going to flow through and give us increased profitability. All right, is DOLLA, says Young Sams, is DOLLA planning to expand outside of Jamaica? There's a question for you, Kenroy.
Sure, I'll take that one, Dan. So we have kind of put the regional expansion plans. We have, I think we discussed this in the last quarter call that we had, so that we can just focus on just meeting the demand that we have here locally, and we have been seeing the demand. So we'll just continue to look for the opportunities locally, look for the sectors that we see great growth potential, and we will continue to just explore those and grow the portfolio locally. And then maybe sometime in the future, sometime in the medium term, we can look back at expansion outside of Jamaica.
Follow up for me, any planned expansion branch-wise within Jamaica to support this ambitious loan growth that you have on your mind?
So luckily for us, we have, I believe over the last 3 or 4 years, we have opened a new branch every single year. So we have been assessing various locations to see where it's most prudent. And if it is, then we'll definitely be exploring that option.
What did you do this year?
The
St.
opening
Thomas?
of a
St. Thomas this
branch
year?
for us. I'm sorry, go again, Dan?
What did you do this year? What was the new branch this year? Was it St. Thomas or?
So we went to St. Thomas
Okay.
this year. So we're in Morant Bay, St. Thomas, and that branch has been doing pretty well for the quarter that it has been opened.
Good deal. And that's a pretty involved process, by the way. Opening up a new branch
Yes.
is a highly regulated thing. You got to get Bank of Jamaica approval, this, that, and the other, etc. So
Importantly, right?
that's something, and it adds cost to the business. But it's something you guys continue to look at, and so we appreciate that. So I think that was the last question that snuck in that I wanted to I wanted to take a look at. One more. It's so long I can't read it before I read it, so I'm going to read it on the fly. Have you pursued any line of credit services so that you have access to cash when you have gaps between raising? So yes is the answer to that, Jerome. That's why they got Mayberry Investments. We're here to help them have access to lines of credits. They actually have like a $400 million line of credit from us and a $500 million line of credit from DBJ, and we continue to work on providing them with those lines of credits to make sure that we can fill the gaps. This big bond raise, Jerome, was the one that was important, and we spent the last, I want to say, 6 weeks working on it. So I'm really excited that we've done the heavy lifting, and we'll close that later this week and finish dispersing the rest of the money to Trevine and Kenroy for them to do their thing. So I think with that, Patrick, unless you have any more questions, I think we're going to wrap up. Trevine, it is always a pleasure to see you. Kenroy, you're the sidekick. You just kind of come along for the fun. It's a pleasure to talk to you. Pleasure to see
Okay.
Trevine. So I hope I'm being very clear. Yes, honey. Okay, honey. Okay, my wife is rebuking me. I'm making this up, guys. I'm in a funny mode. So, guys, I do appreciate you both. To our folks out there, I'd like to bring today's discussion to an end, and I'd like to thank our viewers, as usual, for tuning in. Your support is always appreciated. Big thanks to Trevine and Kenroy, as always, for stopping by and being a part of the show and making it as educational and as informative as it is. I'd also like to thank Patrick for his invaluable contributions and for being a part of the Mayberry team. We're really excited to have Patrick on the team. To our viewers, be sure to look out for future updates on our virtual investor forum by following us on social media. We share all things forum related on our social media pages. Next week, tune in as we speak to the CEO of FESCO, Jeremy Barnes, to bring the latest results from FESCO. You won't want to miss that one. It's going to be great. Don't forget to subscribe to our YouTube channel, Mayberry Investments Limited. And remember, wise investors, slow and steady wins the race. Keep safe now.